Good afternoon, everyone. My name is Corey Hinkle, and I'll be your host today for the Ankerstar Wealth Daily Update. The market's just closed, down about 2/3% today. There's kind of two forces that contributed to that. One, this morning we saw some announcements from the president about some additional tariff threats or potential for additional tariffs on Apple and some places in Europe. So there's that going on. But what I think is probably on investors' mind even more than something like that, a current event like that, is what's going on globally in the bond market. So I'm actually going to speak to that today. We're going to look at some places around the world in the global bond market. I'm going to tell you where I think bonds are going next, so bond rates. And then I'm going to tell you why bond rates are doing what they're doing and what it means, not only for specific companies, but for stocks in general. So if you're thinking, I'm a stock guy, I'm a stock girl, that's my thing, bonds are probably more important than you think. And so it's something that's on our mind, and I want to bring that to you here today. But first, before I get started, I want to remind everyone that this is a financial education presentation. You must do your own due diligence before acting on anything you hear in this presentation. You can find more information, more disclaimer information on ankerstarwealth.com. And of course, the opinions expressed are mine and mine alone. All right, we're going to start here looking in the United Kingdom. So here we go. And I want you to look for some trends here with me. And then we'll look at the United States and we'll see what's going to happen next. All right, so you can see there on the left, you've got the British 10-year, and then on the right, the British 30-year. So as far as a trend or, recent development, we saw that bond rates, and this is globally, they seemed to bottom in 2020. So COVID was the bottom. Of course, after that, there was inflation and a few other things going on, but that was the bottom, and the bottom was near zero. And this, you'll see this trend repeat. Now, getting off of the bottom, where are we today? You can see that British 10-year is the highest it's been going back to 2008. And the British 30-year is the highest it's been going back to 1997 or 1998. There's one more thing, though, it's even more important than looking back in history. I want you to notice, you can see that the 10-year, British 10-year up at 4.677 is what we'd call a new cycle high. So we entered a new rate cycle, a high, rising rate environment, they say, after that COVID trough. And now this new level, 4.677 on the left and then 5.464 on the right, is a new cycle high. So we haven't plateaued yet, still increasing. Let's go over to Germany. Germany, similar but not quite the same. So the 10-year and the 30-year there, 10-year on the left, 30-year on the right. The 10-year hasn't broken to new cycle highs. So those 2022 highs, it's hovered around there. But the German 30-year, sorry if I said British, I meant German. The German 30-year, it's right on those cycle highs, potentially even just now breaking out to new cycle highs. So what are we seeing? These bond rates are increasing. Japan 10-year, the highest it's been going back to 2008. And the Japan 30-year is the highest, it's been since at least the 1990s or before that. So what are we seeing here? Of course, new cycle highs are happening all the time. These bond rates are increasing across the globe. Going to Australia, highest 10-year, highest it's been since 2011. The 15-year, that's as long as you can get there in Australia. About the highest it's been going back to about 2010. Are these cycle highs for Australia? Not quite, but man, it's really flirting with that, really flirting with new cycle highs. And then last one before the United States, Canada. Canada and the United States look a little different here. So not quite at new cycle highs on the 10-year or the 30-year. However, we are in a, in theory, a rising rate environment now. It's at least something that we have to entertain. What does a rising rate environment mean for us if that were to be the case over the next, let's call it 5, 7, 10 years? Again, we can't prophesize that will happen, no crystal ball, but we do have to be mindful of what a rising rate environment would mean, and of course the symptoms that we're observing that could lead to that. So Canada, they're not quite at cycle highs, but those rates do look to have some upward pressure to them. And then the United States, the 10-year about the highest it's been going back to 2007. The 30-year, the highest it's been going back to 2007, maybe 2008. The 30-year is at cycle highs. So this did break above the 2023 and 2024 high recently. And the 10-year is right there. It looks like it'd be ready any day now to hit new cycle highs. So here's what we're going to talk about. So that's what's happening. This idea that rates are rising around the globe. We need to at least be mindful that we could be in right now a rising rate environment. And if you look at that US 30-year, we enjoyed 3 to 4 decades of a falling rate environment. When you have falling rates, every day that rates fall incrementally lower and lower and lower, stocks as an asset, companies or equities, become just a little bit more exciting day by day, because if you can't earn a desirable yield on the fixed income side of things, you have to go somewhere. So again, every incremental step lower in rates puts just a little bit of wind at the back of stock prices and stock valuations. So that's what we're monitoring, right? Now, why is this happening? Why are we all of a sudden in a rising rate environment potentially? Well, there's a couple things. One, we kind of got all the way down to zero. So there wasn't any other place to go but up some. So some people would say this is just a moderating rate, and it's just going to hover around here for the foreseeable future. That would actually be great. So the less volatility we get in the bond market, that's really good for stocks, even if rates don't fall from here, even if they just stayed right where they are, but stayed flat for a long period of time. It's very predictable. It'd be great for stocks. But why is this happening? And if that's not the case, if it's not going to plateau here and we are in a rising rate environment, why? Government debts have been increasing not only in the United States, but globally. And as that money has worked its way into the system, there's still some level of inflation risk out there. That's one reason rates do go higher. Another, probably more reasonable explanation is that government debt has become a little bit more of a focus politically, socially. You may have heard somebody talking about government debt and how it is a problem. The administration is trying to get through the big beautiful bill or big beautiful tax bill that's going to increase government debt further, and that's something. It's just bringing government debt to the forefront of people's minds, and so that's something we have to grapple with. One reason rates might go higher is there's maybe a perceived higher level of risk. If we're going to own the debt of a government that has very high level of debt, then we want to be paid a little bit more for that in the form of yield, because it's a little more risky than it used to be when that government didn't have as much debt. And this is going on globally. This is not just the United States. Another reason rates can increase is because of high growth expectations. And, there is some strong growth expectations built into our economy. And frankly, we're going to need to hit a lot of those. And by doing that, it would benefit our government debt situation and the country as a whole. Okay, now what does it mean? So what does it mean, especially somebody out there who's thinking, I just own stocks, so I don't care too much about global bond rates. Well, it means this: stocks in a rising rate environment, they're going to have more competition than they used to have. For the past 3 to 4 decades, stocks have had less and less and less competition from other investments. Now they might be having more and more and more competition. So as stocks have more competition, they become slightly less desirable. Do I want to own a certain stock that is projected to return me 5% a year, maybe a railroad or a consumer packaged good company, something relatively basic? Would I rather own that, or would I rather own a fixed income asset that has a more guaranteed type of return, kind of a safer, more predictable type of return? That's what investors are thinking. So in this environment, stocks do have more competition. That's kind of across the board. It also means higher borrowing costs. So if you're a company looking to use some capital or borrow some capital to invest in a new project, well, that project probably has a higher barrier of entry now, because you're going to, whereas maybe a reasonable project might have only needed a 10% return to justify the risk of borrowing money for that investment, you might need a 12 or 13% projected return on that capital investment in order to justify it. So you might slow down. The higher borrowing costs can slow down some economic activity. It discourages some new projects taking place, which can actually have a beneficial effect on inflation. That's why rates do rise to fight inflation. If inflation is things getting a little too hot, higher borrowing costs can kind of can throw some cold water on that. So, self-healing in a sense, but that does mean higher borrowing costs. What you also see is for companies that are growing through debt, you're going to see they'll be pressured more than most. So if it's a company doesn't have a great balance sheet, they're using lots of debt to fund expansion and revenue growth and on, those companies would be affected the most. Who would be safe? Would there be any companies that are safe in a rising rate environment, where an investor is still wanting to prioritize stocks over bonds for the long term? There is an argument to be made that some of those kind of famous Mag 7 stocks, those big tech stocks, are positioned well. There's a few reasons for that. One, those companies tend to carry higher growth rates. We'll call it double-digit growth rates, 10% or more revenue growth, 10% or more earnings per share growth over long periods of time. So from a growth standpoint, those companies are positioned well. Also, from an inflationary standpoint, those companies tend to have what they call pricing power. They can determine their pricing more than smaller companies can, or mid-cap companies can. These companies have a lot of strength in the marketplace from a pricing standpoint. Also, a lot of these companies, they fund their expansion. Think of like a Google funding Waymo, right? Or Meta funding their Reality Labs division, or on and on down the list. These companies fund their expansions with their own free cash flow. They're not really taking on new debt. So higher borrowing costs doesn't really hurt them on that side of things. So some of those, it's be interesting to see if some of those quality large cap tech stocks are still the safe haven that they've been for such a long period of time, but it's not out of the realm of possibility that would be the exact outcome in a rising rate environment. So anyway, that's all I have for you today. I know that was probably not the most exciting one, but interesting and worthwhile to me. It's a worthwhile discussion nonetheless. So I hope everyone has a great long weekend. We look forward to seeing you next week. And that's all from us today.